Welcome back everyone to the Audacious Money Witch channel, where we talk about investing and trading and a lot of fun things. This video is not all about Alibaba. This video is about the CEO, the management who runs Alibaba, how the integrity and honesty of the management team can make or break your investment. In this video, I want to give you 3 examples to explain and demonstrate why CEO is nearly the most crucial thing to consider. When it comes to stock picking, like my ESLA stock has that key man risk, as they say. Number 1 is about Jack Ma, Alibaba, and the current CEO, Eddie Wu. How did Eddie Wu fail to keep up with Pinduoduo? Number 2 is the most recent big global news. Restaurants, Chipotle stock falls as CEO Brian Niccol leaves for Starbucks. Number 3 is about tattooed chef and Playboy stock. How when the CEO lies, investors cry. Why did I love Alibaba? Why did I buy the Baba stock to begin with? It's because of Jack Ma, the key founder. How Alibaba became such a success, it's because of the culture Jack Ma brings to the leadership table. Now that it's pretty much a pipe dream for Jack Ma to come back to his company, it's just feel like Alibaba is just another Chinese tech company run by the CEO that doesn't even speak good English. It's hard to tell if the CEO is telling you the truth when he speaks in another language. Why using AI to translate that in the conference call? Alibaba has been undergoing a major restructuring, splitting into 6 distinct units to enhance operational efficiency and focus. However, this process has also created uncertainty and may have delayed decisive action against Pinduoduo's rapid growth. Eddie Wu has faced significant challenges in keeping Alibaba competitive against Pinduoduo, which has recently surpassed Alibaba in market value. Alibaba's chairman, Joe Tsai, emphasized the necessity for a fresh strategy to navigate the evolving market dynamics. This suggests that Wu's predecessors may not have effectively addressed the competitive threats posed by Pinduoduo, necessitating a complete overhaul of Alibaba's approach. Wu's appointment as CEO of Alibaba Group and head of its e-commerce division comes amid a significant leadership reshuffle intended to revitalize the company. The shift change in leadership indicates a reactive approach to the competitive landscape rather than a proactive strategy. This is why I sold all my Alibaba shares. I don't have faith in Alibaba's new management team. Now, as we head to Chipotle, I am going to show you a good CEO and what it looks like. Chipotle stock fell more than 10% on Tuesday as the company announced CEO Brian Niccol would be leaving his role on August 31st to become CEO of Starbucks. Niccol began as Chipotle CEO in March 2008. Chipotle stock has risen more than 770% since he took over. Chipotle's board named Chief Operating Officer Scott Boatwright as interim CEO. He's been at the company since 2017. Starbucks CEO Lakshman Narayanan has been replaced with Chipotle CEO Brian Niccol, effective immediately. Now Niccol will start in his new role from the 9th of September. The company's Chief Financial Officer, Rachel Ruggery, will serve as the interim CEO until the time.
Well, I want to make a point here, sir. You are still expanding as if it is business as usual. You add, for instance, on the quarter, you talk about opening stores in Honduras and Ecuador. Is it not time to pause, sir, and figure out what's really going wrong and spend a deep dive and making it so that this decline in comp store numbers does not continue? Because it is perilous to the actual existential existence of Starbucks.
Jim, thank you for the question. What I would tell you is, if you look across the world, our system sales in Latin America expanded double digits. Our sales in Japan expanded double digits. Our business outside of Malaysia and Indonesia in Asia Pacific showed growth. If you look at the US business and look at the fundamentals of the US business, we are holding share in the US. We are still the largest player in out-of-home coffee. If you look at some of the metrics that we have into
Tim Hortons said you are not holding shares, sir. I regard them as being seminal companies that are just as good when it comes to McDonald's says you are losing share. I can't go against those three companies. They are too good and too honest and too big for me to dismiss.
We are the leading category player in coffee. I'm talking visitation share and what we have. If you look at our in-home coffee business, it grew share 140 basis points. But if you look at the business underpinning us, tea grew 8%, cold grew 1%. So there are elements in here. If you look at our partner sentiment and what we have inside stores, attrition is down to its lowest levels. So there's work going in. The thing we didn't do enough of is really attack the occasional customer with delivering and communicating value to them in a more aggressive manner. That's what the plan we have does.
Now the coffee giant sales have been struggling in the recent quarters due to weak demand in the US and China. It's just been a little over a year since Lachlan Merriman took over as the Starbucks CEO, but the company's performance has struggled under his tenure. Now the company's shares have fallen about 23% under his tenure, from nearly $99 in March 2023 when he took over to about $77 as on the close of 12th of August. Now the company was also facing immense pressure from activist fund Elliott over the performance, and while accumulating significant stake, the fund was in talks about Starbucks for board expansion and governance improvement. But what's been the larger issue? Slowing sales. Now Starbucks reported 2 consecutive quarters of sales decline, and this is the first since an April to June quarter. Same-store sales fell about 3% as transactions also declined about 5%. Merriman had attributed this to a challenging consumer environment weighing on sales at its cafes, and meanwhile experts had been attributing this to a lot of competition and lack of innovation, and also worsening store experience. Now the company had put in place turnaround plans for the stores that included experience and product upgrades and promotion, but that is yet to show results. In fact, the decline in sales also prompted Starbucks founder Howard to take note and say that the stores require a maniacal focus on customer experience through the eyes of a merchant. He said, the answer does not lie in the data, but in the stores. Wall Street reacted huge to this move. There were a lot of shares traded hands, and volume was off the charts from both companies' shares. In the same session, Starbucks stock jumped 21% just because a better CEO is coming. We know Starbucks has a widely known brand name, just like Alibaba. If you have a CEO that doesn't have integrity and lies to the shareholders, the stock will go down. I am sure you all heard about what happens to Tattooed Chef, Jeremy's TTCF stock. I got involved in that experiment. The result is not what I was looking for. In fact, the CEO of Tattooed Chef turns out to be a fraud. He tells you everything is fine when he is taking 4 salaries from the company. Now for the Playboy, the CEO that loves to buy high and sell low. March the 2nd, 2021, the acquisition of Lovers was completed for a purchase price of $25 million of cash. Lovers is expected to generate $45 million in revenue over the next 12 months and approximately $5 million of adjusted EBITDA. We are thrilled to officially welcome the Lovers team to Playboy Group. This transaction accelerates our company's sexual wellness growth strategy with a new owned distribution platform, superior merchandising, leadership, and strong product innovation capabilities, said Ben Cohn, CEO of Playboy Group. Lovers' intimacy offerings align with the fastest growing category on our Yandy platform, and Lovers' brick and mortar and digital retail footprint represents immediate expanded distribution for Playboy branded sexual wellness offerings. October 5th, 2023, Playboy Enterprises has entered into a definitive agreement to sell its Lovers business to LV Holding for a price of approximately $13.5 million. February 1st, 2021, Ben said, "We expect this deal to be accretive for our shareholders." The stock price from 2021 of Playboy is in the 50s. Now it's in the 50 cents. How accretive for your shareholders. Wow, great job, man. Playboy magazine, scheduled to return in early 2025, will serve as a powerful promotional tool for our relaunch and will feature not only Playmate and celebrity collaborations, but also many iconic franchises such as the Playboy Interview, 20 Questions, and the Playboy Advisor. Playboy is known for launching the careers of some of the most talented women in the world, and we are reviving that legacy with a global search for our newest Playmate, kicking off with an 8-city casting tour starting next month in New York City, and culminating in the reveal of the 2024 Playmate of the Year in the new magazine. The rebuilding of Playboy's licensing business continues to progress. In the past few months, they signed multiple new deals, including with a new apparel, accessories licensing partner in China, a global condoms and gel lubricants partner. Yes, Playboy is going to sell condoms now. Ha 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 ha! A new e-commerce shop partner, and multiple other deals amounting to a total of $45 million and minimum guarantees over the coming years. Their pipeline continues to grow, and they are optimistic about what lies ahead for the licensing business. Total revenue was $24.9 million compared to $35.1 million in the prior year period, reflecting a year-over-year decrease of $10.2 million or 29%. Approximately $1.4 million of the decrease was attributable to the Playboy.com e-commerce business, no longer being operated by the company in 2024. There were also declines at Honey Birdette and in the company's legacy digital business. Direct-to-consumer revenue declined $5.2 million or 26% year over year to $14.5 million. Revenues from Playboy.com e-commerce declined by $1.4 million as the company transitioned from being an owned and operated model to a licensing model. Licensing revenue declined $5 million or 49% year over year to $5.3 million. The decrease is primarily attributable to China and the termination of two of the company's three largest licensing agreements in late 2023, which management has already begun to remedy by entering into multiple new licensing agreements in recent months. Playboy ended the second quarter with approximately $17 million in cash and cash equivalents. I think from what I see, this Playboy CEO, like Tattoo Chef CEO, he loves to help investors feel better about their failed investment as he keeps giving them hope, and actual financial of the company suffers. Are you a buyer of Playboy at current levels? Let me know in the comments below. I am not buying this stock until he steps down. Now you know why the CEO is so important.